Hey all, 5 Minute Trader here with a bonus episode. Markets were moving quite a bit today. I checked them on my phone. So maybe this is like a 10-minute trader a day. I don't know. The long and the short of it is, as a general tip and something I think about myself, is I want to sell options when the markets are moving, because what that means is volatility increases, options become more expensive. That's the time it's worth selling options. So I know I talked earlier and I said, you know what? Metals are down a lot today, but they're down from a high. So I don't know if I want to like sell a put like at 30, because that's going to make money if the stock stays the same or goes up, or not a stock in this case, an ETF, excuse me. But like, I want to take some advantage of the fact that volatility is increasing. So I might do something like sell a put down here. So let's look like, see like 27. So let's go to trade with 58 days. Let me clear out what I have in here. So I could sell a put at 27. There's not much money in that put, right? It's, what am I getting there? $34 or 60 days, 50 cents a day. What I could do is do like a wide strangle where I'm also selling a call up here. That's going to earn me, almost $100. And there I'm making more money each day. Me personally, I am not a lover of naked calls. That's where you just sell a call with no protection at all. The reason I don't like them is because in a lot of markets, not necessarily metals, but in a lot of markets, like the SP500 is a classic example of this, there's an upward drift. So it's always going up. So if I'm selling or if I'm creating a position that makes money when something goes down, I'm almost putting myself at a disadvantage because I'm fighting this upward trend. Now, the upside, the flip of that is that markets, when they do go down, they tend to go down fast. So I can make a lot of money on a downward movement. But to bring it all back, I would typically add some protection in here. So right now, if you look, I've got a maximum profit of $100. I got a maximum loss of infinity. Theoretically is true. Like if gold went up forever, I would just continue to lose money. So what I can do is I can create a spread where, in addition to my sold call, I can also buy a call right here, a dollar or so above. That's going to bring down my max profit, but also cap my losses, right? And as I make this spread wider, let me scroll down, my maximum profit goes up, and you see my max loss, it changes, but not a whole lot, right? So I could do like a wide spread, something like that. One of the really interesting positions that sometimes I see people put on is what's called the Jade Lizard. The Jade Lizard is where you're trying to get to like around $1. And let me flip to curve view here. Yeah, there we go. So bring this up a little bit and bring these down. There we go. So there's a Jade Lizard. So let's see if I can a little bit more. Okay. So what I'm trying to do with the Jade Lizard is I'm selling a put and a call on either side, kind of like a strangle. And then I'm buying a call in such a way that I'm collecting a little bit more money for the overall trade than the width of the spread, the call spread. What that means is that I will make my $100 over my 60 days. But if the underlying I'm trading on continues to go up, I'll never be in a situation where I'm losing if it goes up. I can still lose if it goes down. That doesn't stress me out a whole lot in something like silver, gold, metals, because like silver isn't going out of business. So I'm probably gonna be able to roll this put, but this is an interesting way to create some upside protection when you want to sell into high volatility. But you're worried that, oh, you know what? It's pretty high, I might keep going up, something like that. There is such a thing as you could do like reverse Jade Lizards as well. They're much harder to do. But this is just an example of how you could do it. If you want more information on that, give me a shout in the comments and I can provide more detail on Jade Lizards. Now, aside from that, just to finish this up, the markets are down too. So look, like the Qs are down, IWM, that's the Russel, is down, SPY is down, and DIA is down. And as I look at these, first thing I'm looking at is the IV rank. So the diamonds are 45, 34 on the spiders, 46 on the IWM. Okay, so IWM has the highest IV rank. It's also, look, it's making some pretty big downward movements. Let's take a look at some puts in IWM. Let's go to trade, go to table. Let's go to 58 days. I know I keep saying 60 days. I tend to round off numbers. Just keep an eye on that for me. You'll know why I do that. What have I got here at this 30 delta? The 30 delta is 208. But where is that? 208. That's pretty low. That's like down here. Like if I wanted to feel more comfortable, I might sell at like the 205. What's that get me? 205. That's the 26 delta. And I'm going to make, $360 over 60 days. And one of the beauties of puts is that they can often be very easy to roll. So even if the market were to, like, quote unquote crash, go below, where am I at? 205, go below this, even down to like here, right? It's been down to 160. I can either try to roll that put. Typically, as the markets go down, the cost of options goes up. So it makes it easier to roll. Or I can, in quote unquote worst case scenario, I can end up owning 100 shares of IWM, which is the Russel index. That would kind of suck, but at the same time, like there's this upward market drift. Eventually, it's probably going to come back. Other options that traders do, I don't tend to do this myself, but you could always create like a stop loss where you're like, okay, I only want to lose like 20%. And then I'm just going to get myself out, take my loss, and go on to my next trade. So there's some options that you have. Let me know in the comments what you think. Bonus episode today. Thanks a lot. Be sure to like the video if you like it. Hit subscribe to get these updates. And I'll talk to you soon. Thanks again.